Welcome back to the second episode of my new trading audit series, where I meet with one of you for a one-on-one trading audit. During the one-on-one, we'll dig into what you've been doing well, areas that you can improve on, and take a deep dive into your recent trades. Today I have Tanner on, who's been trading seriously for about a year now. We're currently in a bear market, and while Tanner does a good job keeping his position sizes down and his losses at a minimum, in order to survive this bear market, he needs to improve on his entry tactics. In today's video, we highlight some important topics, like progressive exposure, how to adjust our own strategies to fit the market environment, and also alternative entry points that gives us lower risk on the trade. If you'd like to be part of the next trading audit, you can email me at stocktrickswithnick@gmail.com. Enough of the intro, let's get into the episode. Notice from your trades, you're more of a swing trader, right?
Yeah, I try and do longer term positions, but lately it's it's been a little tough.
Yeah, that's that market environment working against us. With lower liquidity in the market, things just tend to trend poorly. So a lot of my best trades have been pretty interesting entry points, and then very quick like profit taking, and really trying to keep my win rate as close to 50-50 as possible, but both the average gain and average loss has been really tightened up in this environment. So it's more so turning over the edge versus swinging for triples and home runs in the market.
That's what I've noticed is like I need to go for like the 5% or 5 to 10% gain and just walk off because you're not going to get these big hitters anymore or anything like that.
Yeah, and you'll see a few stocks, like I know AEHR, that one comes to mind that ran 100% or something. But we have to think about this in probabilities. Like of all the stocks that we're looking at, we only take trades in a very few number because we want to concentrate our positions. And if we're only taking a few stocks, what are the likelihoods that we're going to hit that one home run stock in a very tough market, right? So as tough as it is like putting on a trade, seeing one break out 10%, taking that profit like into strength, and then having it run another 30%, you play that hand over, I'm thinking like poker, you play that hand over 100 times, you're doing the right thing over a long period of time. That's going to help you out better with the environment. Yeah, so next kind of question, where do you see yourself in your trading journey? And like, how long have you been trading the style that you kind of identify with now?
Really not very long. I would say like where I'm like actually serious and like journaling and like things like that, like a year. But like I was trading for like 3 years or so, but I wouldn't consider those first 2 years like anything. It was more of just like me not learning anything from it and just kind of wasting money in a sense.
Yeah,
But
I've been there too.
like writing things down and stuff like that and kind of building some consistency has definitely helped in the big picture.
Mm-hmm. So about a year. And then right now, if you take a look at your equity curve or like your account balance, do you see a nice like uptrend where you're putting in higher highs and higher lows? So even when you're making mistakes or when stocks are working against you, your account balance is like putting in a higher low, like we look at stocks, or do you see more of like a boom and bust equity curve?
I was doing pretty well before this like whole bear market thing,
Mm-hmm.
and then I've kind of been getting my butt handed to me in a sense since this whole thing has started. But yeah, I was on a pretty good like upward scale, and then it's definitely on a downward trajectory as of late for sure.
Definitely. Yeah. It's been a challenging market. And even if you were trading well in the second half of 2021, I know from the growth stocks that we all loved and traded in 2020 and the beginning part of 2021, those started to crash in like March of 2021. And then from April to September, I made no progress. I kept on getting chopped up in my account. That was kind of like one of the more difficult environments to trade because it was so choppy. It wasn't like the market was collapsing, so you just get out and like you're just managing your capital on the sidelines. It was something that you needed to like test the waters, get stopped out, test the waters, get stopped out. And that was one area where like, and I want to really kind of hammer this point home with you is like the market environment is so much, I would say, more important than any individual strategy. And knowing when your strategy fits the market environment, that's when you can really press on the gas and get the large gains in a short period of time versus the other probably like 70%, 75% of the time during the year, either your strategy, like your system with your personality, isn't hitting the market, or the market itself is not in a conducive, like strong uptrend, anything like that. So what I learned from 2021 was use the market feedback and use your trading statistics to really kind of either dampen or expand your expectations of the trades and of the markets. Because if I look back at my trading stats in that April to September period, I would have noticed that like I'm only getting 5% on my average gains, and my average losses are like 4%. And if my win rate is under 50%, I'm hemorrhaging money. So kind of keeping those trading stats and keeping them up to date, where it's like the last 10 trades or last 20 trades, what's the market feedback giving you? And do you need to adjust your expectations and then sell into strength quicker? Or if you're getting like 3-5 trades that you take profits at 10% and then it runs another 30%, then you're like, okay, these stocks are working. My average gain on winners are expanding. I can be a little bit more aggressive with winners. So really pairing like your own strategy with your own personality, and then knowing the times and understanding the times that the market conditions are ripe for you to make a lot of money. That's what's going to take you from like a boom and bust trader to like not an expert, but like a consistent trader where you're putting in higher lows and higher highs in your equity curve. And that takes time. Like that's something that I told you just a couple months ago I was struggling with, and I'm still not amazing at that. But this year especially, I've understood that when you combine those two, that's the most important kind of aspect of like the stock selection. Is the M factor in CanSlim is the market behind you. Right. I know some traders are against this, and I would be for the most part, but do you ever paper trade?
I used to whenever I was like first starting a while ago. But I find it that like emotionally I'm not that involved because I'm like, it's not
real money,
really,
not real consequences.
Yeah.
So I don't paper trade anymore, but what I do typically during the day is or coming into the day, I'll have 10 stocks that are on my like general focus list, and I'll have like potential entry points on all of them. But out of the 10 setups, I might be only interested in executing a trade in maybe like 2 to 5 of them, depending on the day. But I'll use those other 5 as just kind of like mental trades or checkpoints to see like, okay, this stock went through my buy point and it closed above my buy point. Now let's kind of track this like mental trade, because that'll just give you more feedback. Because these stocks are ending up on your watch list because they're fitting your criteria, and you would be buying them at the same buy points that your strategy would call for. So just to get more data to kind of understand the market environment, I've been doing that more so in the last like 2 months. And it's been helping me either gain confidence and start to press in either position sizing or number of positions, or really scale back, saying like, Nick, only 1 out of 10 of your stocks went through the buy point and it closed below that. This is not either your stock selection's wrong or the market's wrong. Either way, you don't want to be pressing the gas.
Yeah. That's smart. I think I'm going to incorporate that, because then you're not taking the financial risk, but then you're also like, you're learning at the same time,
Yeah. And I mean, you could still journal it like it was a real trade. Like, okay, I would have bought here. We got good volume coming through like the area that I was looking for, meaning more people were coming in at the same spot. Or reverse, like, okay, this immediately failed at the pivot and then crashed 8%. That's bear market type activity. I know I shouldn't be taking that with size, or I need to be out of that trade as quickly as it like comes back into my entry. So just getting that extra kind of data of the market without paying for it has helped me out a little bit. Next is like, where do you struggle and where do you see like the most confidence in? I have 4 kind of bullet points here: your trading knowledge, risk management, stock selection, and trading psychology. So I guess if you want to go through each of those and just like grade yourself, and if you have any questions on any of those, feel free to ask me.
So I would say struggling most right now with the market conditions, I would say stock selection. Normally, if I'm not busy with work, my risk management, sometimes it's too tight to where I don't let it work, you know. But
Hmm.
lately, I've just been pretty quick with selling. I mean, obviously, there's outliers where I make mistakes, but for the most part, I sell things too soon.
Hmm.
Um, my trading psychology is normally it's normally okay as long as I mean nothing crazy is going on in life and stuff like that. But I would say um, stock selection, yeah, out of the four.
And do you find yourself getting any like slippage on your entry points? Maybe you're busy at work when an alarm goes off, so you end up buying it a little bit later, or
I would
are you pretty good with like if you don't get it right away at the price you want, you're good with just letting it go?
I normally like if it's over like 3% past my buy point, then I'll just be like, okay, well, I missed that one. And then I could set an alarm or an alert on there and say like if it comes back down. But then if it comes back down, then it's not as strong as we thought it was. So then it's kind of a double-edged sword in a sense if it
Hmm.
comes back down. But no, normally, especially like at open, I can step away from my work computer for a little bit and kind of get things done at a later hour.
Gotcha. So one thing that I would say about that, and maybe you just chose 3% as a talking point here, but what I noticed in some of your trades is you bought a little bit higher than I would have expected a potential entry point to be. And with your average win rate of 3.5% from the trades that you shared, if you're buying already up to 3% from the ideal entry point, well, there goes your average win. So
Right.
especially in this market where your average win is very subdued and very kind of much lower than in a stronger market, if you're not nailing an entry price like exactly where you want to be getting in, you basically are expanding where your stop loss would be. So by doing that, you're kind of imbalancing the risk reward ratio in the favor of the market taking your money.
Right.
So, especially when market conditions are this tough and there's less liquidity in the market, very few leaders outside of like the solar stocks, some biotechs. Unless you hit it perfectly, it's just more of a market to take those mental notes and get those mental feedbacks. Because if you're giving the market any edge to cut you, it's going to cut you. But trading psychology, I really like that you said in the email that we've gone back and forth that you're not trading with large size because the market environment is poor and you're not getting that traction. And I want to really applaud you on that because that's something not a lot of people, especially like 1 to 2 years. I mean, even like the first 5 years, depending on like who you've been following on Twitter and learning from, they'll see a tougher market, they'll take some losses, and then they'll try and revenge trade to get that back, and they'll put on larger sizes or add to losers. And you didn't do any of that in the trades that you sent me. So um, I really do want to applaud like the trading psychology and what you've been doing there because it's tough. Like if we're on month 8 of a bear market or like sliding through a bear market, people are getting worn down mentally of not making gains. But you did a good job, even in one of the tougher areas where the market slid down, the 2 weeks that you sent me notes on, of only having your average loss at 3.5% and not trading with very large size. So I think that is one of the better things that I've seen from the trades.
Yeah, it's I kind of pay attention to my win rate, and it's been going down. It's on the curve, and so I was just like, man, like I'm really just buying to stay involved. You know,
Mm-hmm.
at this point, I'm not expecting like if it happens, if I get a big win, then awesome. But like with the size, it really won't be a big win. But at least I'm doing something right. But that's kind of where I'm at right now with the current market environment is just kind of staying afloat and waiting for the sun to rise in a sense.
Yeah, and that's exactly what you need to be doing. Have you heard of the term progressive exposure before?
Yeah, when you're trading well, you increase size, and then when you're trading bad, you decrease size.
Yeah, yeah,
Is
exactly. So basically, if you can get say you put on two or three pilot positions of 5% of your account, very small, and those immediately start working out and they break out, moving your stop loss up to even, so you take that initial capital risk that you put into the market out, and then using that on a different trade, that's where you can double your size in the market, double your exposure while keeping that initial capital risk. So if the market crashes one day, everything comes back and stops you out, you're still only getting that initial kind of layer of capital that you risked. But if the market does kind of bounce and then start to trend for a couple days, then you're just building, building, building while still minimizing that risk. And then you get major asymmetrical risk reward in your favor. And that's how you can make those very large gains in a shorter period of time with smaller risk. And
so what? Whenever you do that, how much percent are you letting it go past your buy-in, or is it just immediate?
say I take, usually it's like two positions. So say I take two positions of 5% of my account. So now I'm 10% involved in the market. And usually my stops are around like 3%. So if the stock breaks out over 6%, like two times my risk, then I'll move my stop to even on those two. And then probably my third trade, I'll do like a single trade, but then size it up to either 10% or 15%. And as I'm like getting more traction, then I can keep sizing up like the next one. Now there is a time where if you're sizing up, sizing up, sizing up while the market's railing, 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 you know your largest size is going to be when the market's kind of exhausted at the rally. So what I tend to do with those is I might still have it at a larger size, say 15%, 20% of my account. But if I know I'm putting that on day 3 or day 4 of a rally, of a bounce, then I'm looking for a very quick gain where like if it's up 5%, I'm taking half of that off into strength and then moving my stop to even.
Yeah.
If I'm on day 1 of a potential bounce and I'm gaining traction and I already have stops at even, well, then I'm going to be a little bit less aggressive with my next position about selling a large portion into strength. Like I'll still be pretty cautious and move either half stop up to even just to reduce the downside, but I'll be more patient with the winners that are on day 1, like day 2, day 3 of a rally versus new exposure I'm putting on day 5. Because if you look at these bear market rallies, it seems like they start on low volume. No one thinks it's anything that you could be trading, so they don't get in. And then by the time like the general public is convinced, like, okay, the market's back to being strong, they just rug pull you. And then if you're trading your largest size and you haven't been taking profits on the way up and moving your stops, then you're going to take your largest kind of pullback when you're at your largest size, and that's how you get that boom and bust cycle on your equity curve. Something I learned from 2021 trading. That was something I did very poorly in that year. Do you have a like daily and weekly routine? And if so, can you just walk me through that so I get an understanding of like how you're preparing yourself for the next day?
Yeah, so normally I go through like my scans, like the volume, gappers, things like that, 52-week highs. And then that's kind of for buying purposes. And then once I buy, I kind of jot down like, hey, I bought this. And then I write like why, like just like something small, like BO, like breakout potential, something like that. Just try and keep it brief so I can get like pay attention to the things that are going on. But
Mhm.
and then when the like after everything the market closes and everything, then I kind of jot like have a spreadsheet that I enter like 5 point, where my stop loss is going to be set. Well, I do set a stop immediately before. I'm not just buying and then letting
Yep.
it roll. But then excuse me, then I'll do the stop loss, and then um, I'll go into the spreadsheet, put my buy price, stop loss. Let's say I got stopped out, then I'll do like kind of what went wrong in that trade. And then I normally just wait till the weekend to go over all the trades at one time.
Hmm.
And so then I'll just go through all that. And then I'll do the same thing monthly. Is like I'll go over the same trades that I went through weekly again to see maybe I catch something that I didn't see before,
Good.
and then kind of just go through that. That's pretty much, I would say, all like my daily, weekly, and then I have just that one monthly.
Yeah, I really like that monthly process too because like taking losses is hard and it's painful, right? And losses are really the best teacher. They give the most feedback because when we get a winner, that's kind of what we expected by putting on the trade. Otherwise, we wouldn't have put on the trade, right?
Mm-hmm.
But by taking that loss, you feel the pain once, you get that learning experience once. Then you do it the end of the week on a like you cleared your head, you come back on Saturday, Sunday, whatever it is, and then you go through with another open mind and you're like, okay, should I have bought this at all? Did I manage this well when I had the trade? Could I have taken profits on a portion to reduce my risk? Stuff like that. And then you look back on the month, a third like fresh set of eyes, and then you can really look, okay, what was the market doing? Like what was the group that the stock was in? How was that trending? And that's another thing that I've been taking away, and we'll talk about with your stock selection, is really focusing on the strongest stocks within the strongest groups to just layer on that probability on our side. Because you're going to hear me say this 1,000 times on my channel, but trading is a game of risk management and probabilities. So there's no absolutes in trading. If there was, then everyone would make a ton of money. It'd be super easy. But we have to train ourselves to think in probabilities. And the only way we can improve our probabilities is by stacking different either edges or like strong market, strong group, strong stocks, fund ownership increasing, stuff like that into that trade probability. So
That is
just going
something
back
that,
and really having that wider lens of the month when you're reviewing, that's an awesome process. And to the viewers, I would definitely stress doing that yourselves.
that one thing that I know I need to pay more attention to is the groups that you mentioned, because that's something that I haven't really paid that much attention to until lately.
Yeah, I'm
And
going to grill
it's
you on that
definitely
when we get
been
to the stocks.
it's been very helpful to pay attention to the groups for sure.
All right, Tanner had sent me 22 trades that he made from August 23rd to September 2nd. During that time, the QQQs were down 6.1%. S&P 500 was down 4.9, call it 5%. So this was definitely a challenging environment for the market. And all the trades he made was from the long side, except once we got down to it in August 29th, there were some shorts that we'll cover. But in that challenging environment, of those 22 trades, he had a win rate of 36%. His average win was 3.5% with an average loss of 3.5%. Now, I didn't have the data of position sizing, so potentially his average wins could have been larger sizes, but with the win rate under 50% and your average win and average loss right at the same rate, that's not a winning formula, right? Because losses actually work geometrically against us. If we take a 33% loss in our account, we now need a 50% loss just to get to break even. So for the trading stats to work in our favor, we either need to have a win rate above 50% and the win-loss, average win and average loss at the same rate, or we need to have our average win much larger than our average loss. And that's typically what a lot of the market wizards have done, US investing champions. Their win rate might be between 40 and 60%. I know that's what Mark Minervini talks about in challenging environments. He's 35 to 45%. In good environments, he's 55 to 65. But because he keeps that asymmetrical risk reward in his favor of getting his average gains around 2 to 3 times his average losses, that's when you can, it doesn't matter if you're not winning every trade, it doesn't even matter if you're winning half your trades, you're still going to be making progress in your account balance. So with those trading stats, it was a challenging environment. I don't want to put this on Tanner, but that's something that if we're going to be trading, we got to kind of get that market feedback and improve our strategy from there. His largest win was a 10.1% gain, and his largest loss was 6.5%. So another thing that I want to applaud Tanner for is largest loss, only 6.5%. That's well within a normal range. Typically, like in this bear market, I want to keep my stop losses as tight as possible. So typically my stops are around 3%, 5% is getting up there. But 6.5%, that's not disastrous. That's not largely impacting his account unless he put his entire account on that one trade, and I know he did not. So keeping that average loss and largest loss in check, especially during a bear market where, I mean, the market's not on our side. It's going to be tough to trade and make progress. So you did a great job of keeping those things in check. One thing that we'll cover is just your stock selection and entry tactics going forward here. But do you have anything to say about your trading stats?
I would say the 6.5 was a mistake. I should have got it sooner.
Yeah.
And I do need to tighten it up to normally I try to do around 5% for a stop loss, but I think I do need to move it to closer to like the 3% range because of the market conditions for sure.
Yeah, one thing Minervini said on an interview was you can't control how much you make on a trade, but you can control how much you lose.
Good
So
point.
if you're keeping your trading stats and see your average gain on a winner is only 5%, if we're going to keep that asymmetrical risk reward balance in our favor, then we need to then limit our stop losses to about 2.5 to 3%. So once that average gain starts to expand, then we can be a little bit looser with our stop loss. But we really want kind of a 2-to-1 ratio at least. That makes that 40% average or 40% win rate still profitable. But we can't control the upside, right? So it's only the downside we can control. So that's the kind of lever or the gear that we need to be switching depending on the market environment. One thing that was a trend that I saw was you kept buying like a little bit later on and breaking into new highs. So what was another one? CF you broke, I think it was on the 25th. Let me see. Yeah. So CF buying right into the new high. It was a gap up on this day as well. And at this point, that's the liquidity that institutions are looking for. They're selling into that area, and then you could see a quick drop from 120 down to 100. Now you did a good job by managing your risk. That was the 6.5% stop, but it wasn't a 20% loss, anything like that. So again, you're doing a good job with having your stop set as you're getting into trades, not letting kind of emotions take that stop loss and really open you up for large downside risk. But buying at these like clear pivots and breakouts into new highs is going to be very challenging. Like again, you might find the 1-2 stocks that work really well, but if we're playing this hand 100 times in a bear market, you're buying breakouts into new highs is going to be in an area where you're not going to have as much success. Now, if we see a bunch of new stocks like breaking into new highs and holding that area, then we can get more confidence in saying like, okay, they're like we're in a risk-on environment. People aren't using breakout liquidity to sell into anymore. That's where you get that market feedback. Go through like the 10 trades on your mental trade list, and you can get that data. But I mean, you can just go through all the stocks breaking into new highs, and you could see CELH, Celsius. This is one got into new highs, immediately reversed. ENPH, this got downgraded on Friday, but broke into a new high, very volatile at that, like around that area. And these are the leaders in the market. These are just like CF, brand new highs. These are potential leaders in the market, but still buying at new highs, even in potential leaders, you're gonna typically see a lot more volatility. And being one of the weaker hands in the market, as swing traders are, that use stop losses, we have a higher probability of being shaken out before the actual move higher after that initial break.
Yeah, I think what you said is when it moves up, the institutions are trying to get out. I think that that's a good like just mentality to have throughout the whole bear market because if you look at it like that, then you're kind of prepared. You're more prepared than oh, this is just going to go higher or something like that. But then if you think about it from a defensive perspective, then I think that would help.
Yep. And it'll show up on your trading stats. Like I posted one, what was the stock? What was it? PLRX? Yeah, PLRX. I bought this on Friday through this area at 2050, actually like intraday chart. You can see this 2050 area was my entry point. So it wasn't like a standard pivot, wasn't very clear. Like you would have seen maybe the high from the previous day is 2087. I wanted to jump in a little bit before that. There was another one at like 2129. That was too clear. But I sold a third of this into 7.5% right away. And I tweeted, I want to keep selling 1/3 into strength into these pops until I'm disgusted at myself for doing so.
Yeah, that's true.
And so far, I have not been. Like looking back at my trades, I should have been selling more at 15%, like taking everything off at 20% on all the trades that I've taken. I would have been more profitable this year. So until I get that market feedback that's saying, Nick, you're an idiot for taking profit here, we're in a bear market, we're playing defense, we're going for singles and doubles. Like I want to be disgusted at myself for taking profit here. And we'll see if I am. Maybe this is up 50% tomorrow or on Monday, and then I'm mad. But that's one data point, and that's one trade. We'll go from there. So, yeah, trying to take a little bit of profit into that first pop is going to reduce your downside risk. And yeah, just think about the liquidity and if it's coming in or going out of the market, because that's where those that's what's going to determine those liquid zones, either very clear pivots or 52-week highs. I really like your weekly routine of looking through weekly 52-week highs, because those are the leaders that we eventually want to trade after they set up. But we don't want to be buying at that very clear area.
Right.
So one of the stocks that you had on here was Celsius. And this is a stock that I use kind of an alternative entry to get into and sold into strength. So this is one that you bought on the 26th at 110.40. So 26th, 110.40. So you were probably trying to do the right thing here. You saw it break out, and then as it was coming back into the previous high area, that's when you started a position. You're doing a pullback buy, I assume, here?
Yeah, and then it didn't work out.
Yeah, and part of the reason it didn't work out was, I mean, the market just was coming in, right? So we're not going to be able to fight the market. Now, market leaders tend to show relative strength, but this is one that had already pushed from, what is this, 95 up to 120. So over a 20% gain in 3 days. Yeah. It's already made its move. If the market comes in at all after this, you expect the stock to kind of relax and digest that action, especially in a bear market, right? We're not having stocks break out 50% in 3 days. So after a 20-25% move, that first day coming back isn't probably the best time to get in, especially if the market itself is starting to come back in as well. Unfortunately, like it came in and then it kept coming in, broke the 8-day, broke the 21, closed under that. Then like this was pretty scary action for a potential leader. And then since then, market pressure gets relieved. We rally in the market. This rallies back through 100. We're back over the key moving averages. Now we start to kind of monitor this trade.
Yeah.
But one thing that I want to cover is oops reversals, because it could be something that you use to get into these more heavily watched names at lower prices, lower risk entry points, and then so you could be selling into the liquidity zones in this next kind of rally. Have you heard of the term oops reversal before?
No, I haven't.
No. Yeah. So what it is when a stock gaps down under the previous day's low, then the entry point is buying as it comes back and reclaims that previous day's low. So the idea behind it is we gap down on fear or something, but then buying support comes up immediately and starts pressing higher. And I won't do this for like crappy stocks or stocks in poor what's it called, in poor groups, anything like that. But in the heavily watched names, Enphase, Celsius, LI Auto back a couple of months ago, I think that was in June. Those were like 3 of my best trades this year, and they all came on oops reversals right on the 21-day EMA. So with this one, on the 22nd here, we gap down below both the 21-day and the low from the previous day. The low here is 96.23. And if we go to this day, we gap down and the first price movement was up. So I saw this as, okay, someone's trying to catch a bid. This is a name that I've been patient on. I didn't buy anything up here. I didn't buy the breakout off the like Pepsi news. So I've been tracking it. I want to be patient. I want to get as low of an entry point as possible to manage my risk, as close to the 21-day EMA as possible. And if I miss it and it just rips higher, okay, that's a data point, right? But I bought as it was coming back. I waited a little bit for it to reclaim the 21 EMA. So I bought it like $97 here. But even at that area, and on this day, we started getting feedback that I bought Enphase on this day as well, using the same strategy. And we saw the potential market leaders diverge from what the market was doing. So while the market gapped down and stayed down, you saw potential market leaders like Celsius, Enphase, First Solar all start ripping higher. So that's the divergence that we're looking to see to start putting on some exposure, or at least like really watching an area. So with that lower risk entry point, my stop was at the low of the day. It was like a 1% stop. So now if my loss is capped at 1.5%, and I get any gains, that's going to pay for a bunch of other losses as well. So that risk reward is already so in my favor. My win rate on this could have been like 15%. And statistically, it still would have been the right trade to take. Right. So with doing that, and I mean, I didn't know it was going to like close up 5% that day. It opened down 3%. This was like, we put on this trade thinking 1.5% risk. It's showing strength. We're not thinking this is going to go up 5%, actually 8% from your entry point. Then the next day it's going to go up 9. Then the next day it's going to go up 4 or 0.4. That's what we're hoping. That would be perfect, right? But that's not what we expect. And that, like, I'm not coming on YouTube saying I knew it was going to do this. Like that's BS. But I knew I could manage my risk, very tight stop, and it was an area that buying support was coming into a potential leader. And so on this day, I took a third off right at the close. It already paid for all my risk because that was 8%, and my stop was at 1%. So I actually kept my stop loss at the same place on the other 2/3, and then the next day I sold a third. The third day I sold a third, and that was my best trade in the last like 3 months. And it comes from potential market leader not getting aggressive like up at top like near previous highs, kind of getting creative with it, and then using that divergence with leading stocks versus what the market's doing that day. Now, if the market eventually like just collapses, you're not gonna it's not gonna be a profitable trade most of the time. But this even had just 3 days where the market went like down a little bit, then flat, then up one day, and you saw what a market leader can do in a very short period of time. On the 26th here, it looks like you put on 7 new positions. Can you walk me through like what you were doing on that day? Here's the day that we're talking about, the 26th. It was the Fed came out and was like, we're going to raise rates like no matter what, basically. And you were putting on like 6 new positions on this day. So why so many new positions versus like concentrating on like a couple of your best ideas?
Yeah, I mean, I don't really have a accurate answer for that. I couldn't. I would just be lying if I gave you some kind of.
I appreciate the honesty, and that's why we're here, right? Like we're trying to uncover areas of improvement. So this kind of goes back to my progressive exposure question from before. Like, if you're putting on new trades in the market, it should be because you're getting traction on your previous trades. If you're getting beaten up and the market's coming in on your previous trades, don't introduce more risk to your portfolio, because we're getting feedback that's saying, hey, today's not the day. All your stocks are coming back on you. Like, take a break, take a step away, do anything but trade. And like on these types of days, it's hard to tell. Like, obviously we don't know that this is going to be a 4% down day when it's 1% down. But what we do see is market breadth deteriorating. And by market breadth, I mean like the number of stocks that are either holding up or making new highs on the day are getting less and less and less. And in a bear market where we need to be quicker with our entry and exits, we have more compressed expectations of winners. It has to be exactly right. Otherwise, like we don't want to be taking the trade, right? And one big factor of getting it right is market breadth on the day that you're putting on risk. So kind of like the wind at the sail explanation from before is we want to be putting on risk so we immediately gain traction on the stock, so we can immediately move our stop up or take some profit to reduce or eliminate our initial capital risk. If we can't do that on the first day or two of a position, like then we're just being either greedy, impatient, our stock selection's off. Because again, in this market where we expect very little, so we have to be perfect to make money in the market, one big thing is market breadth. If the number of stocks working isn't extrapolating and you don't see stocks like EMPH, Celsius, First Solar, you don't get that like the leadership stocks moving in your direction, chances are this is a day that it's not going to benefit you of putting on new risk, and you're not going to have the chance to move your stop up to entry. You're not going to have a high probability of taking profit on, or a portion of your profit on day one. So we just have to be more patient. And this is something like, I've made this mistake a couple times this year, pretty costly too, of where I notice a couple stocks showing relative strength on a day where the market's just falling apart. And I'm like, I'll be smart, like get in there. But the 30 minutes later, if the market isn't expanding and like the market breadth isn't improving, I need to be taking that trade off. Even if it doesn't hit my stop, just like get out. Because again, this market's trying to punish us every turn we take. So like in that Celsius trade, yes, I got in when the market was poor, but immediately market breadth started improving. So yes, I put on some risk while it wasn't the most favorable environment and the market breadth was poor at the beginning, but immediately I got traction on the trade, and immediately outside of this one stock, setups were starting to work to the upside, buying support was coming into the market. I want to thank Tanner for allowing me to share a one-on-one for this episode of the Trading Audit. While he's doing a great job always placing stops and keeping position sizing low in a tough environment, I'm sure Tanner has learned a lot from our one-on-one. To summarize what we covered in this video, you need to remember that we're in a bear market. This is a market that's trying to hurt us for any mistakes that we make. You need to either be exactly right with your entry points or pass on the trade altogether. Only start sizing up and increasing your exposure if you're gaining traction on your recent trades. And as always, listen to your trading statistics to build more accurate expectations for your next trade. Thanks for tuning in today. If you guys enjoyed the video, please leave a like and subscribe to my channel for more trading videos. And if you'd like to be a part of the next trading audit, you can email me at stocktrickswithnick@gmail.com. Have a great day, and I'll see you guys in the next video.